Most beginner traders struggle to find consistency in the markets with their strategy and end up strategy hopping. In this video, I'm going to show you my personal profitable strategy that helped me pass 4 funders this year. But before we get into that though, there's a very serious topic we have to discuss. That's my haircut. Do you guys see this? Ooh. The lineup is serious, the waves are serious, the beard is serious, everything is serious. But sorry. Onto the actual video. Okay guys, so this is just a quick overview of my strategy in itself. So in my strategy, there's 2 different ways it can be traded. That's what both of these are for. The one on the right is the continuation model. The one on the left is the original, the normal way I use the strategy. So starting off with the left, I basically trade order blocks, by the way, if you can't tell from the OB. But what you need to see is all 5 of these confluences for me to at least deem the order block valid. So you need a liquidity sweep, a break of structure / chalk. Because break of structure is with the continuation model, chalk is with the original model. And then you need a fair value gap in the expansion move. I'll explain all of these a bit more in depth as I'm going along. You need no fair value gap near your stop loss, and last and not least, it has to be unmitigated. So starting with the liquidity sweep. Depending on what you determine a liquidity sweep is, some people like to see like swing point swept. Me personally, as long as the most recent high or low is swept, I'm more than content to take the trade. So you need to see a sweep of at least the most recent high or low, depending on whether you're bearish or bullish. So I need a liquidity sweep. I say liquidity sweep, I mean I need to see at least price wick that high or that low, or see a nice strong close above or below and then a reversal. So yeah, that's all it really is for liquidity sweep. In terms of break of structure and chalk, for this example, I'm just going to deal with chalk because we're talking about chalk, which just means changing character. So it just means if price goes from bullish to bearish or bearish to bullish, we just change character. I need to see a chalk of, like I said, with liquidity sweep. Some people say swing points they need to see chalk of, or like far away areas. Me, as long as the most recent high or low is swept or broken out of, rather, I'm more than content. And with the chalk, you need to see a nice strong body close below the lows. So in this case, it would probably be wicks on the charts. You need to see a nice body close below. If price wicks the low, that's not valid for me. I don't want to take that trade. So that's it for break structure and chalk. And in terms of fair value gap in the expansion move, in this case, the move that would be the expansion move will be this move here, from this high to this low, because we expanded away from the order block. That would be our expansion move. So that's really it. And you just need to see a fair value gap in this whole move. So whether it's all the way up here, all the way down here, just before we reverse, even if price dropped all the way down here before we reverse, all you need to see is a fair value gap in the expansion move. It can be all the way at the top, all the way at the bottom. As long as it's there, it's valid. And then the second to last one, is no fair value gap near your stop loss. Assuming we were to enter off this trade, our order block here, our stops will cover the high. And you need to make sure the high that you're covering or where your stop loss is, there's no fair value gap that's lining up with it. Because if price is reversing, you're expecting price to go to that fair value gap anyway. So why would you put your stop loss there and try and take the trade? And then the last one is that the order block itself needs to be unmitigated. If price shoots down from that order block away, you don't want to see price come back into it twice and you're entering on the second time. Because I always say this as a rule of thumb. If price comes into an order block for the first time, the chances of it holding, let's just say it's around 60 or 70%. The second time it comes in, just know it drops all the way down to like 20 to 30% chance of it holding. So you don't really want to be there on the second time or the third time or the fourth time. You want to ideally be there first. So that's really it for all the rules I need for my order block for the original. In terms of the continuation model, you really just need to see the exact same thing. It's nothing spectacular, nothing crazy. You just need to see all 5 confluences present, and yes, all 5. If even one of them is missing, then don't take the trade. I'm telling you guys from experience, it doesn't work out well. Leave the trade. But yeah, you need to see all 5 present. In the continuation model, the only thing that's different between the continuation and the original is that you just, instead of calling it a chalk, you call it a break of structure. It's nothing really crazy. So the continuation model, as it says, will continue with the trend. The original order blocks tend to be a reversal strategy. So you use them switching from bullish to bearish or bearish to bullish. Continuation model happens when we're going from bullish to bullish. So as you can see, we need the exact same thing. We need price to sweep at least the most recent low. We need to see a break of structure, a strong close or strong body close above the high. You need to see the fair value gap. In this example, I drew the fair value gap in a different place to show you guys that it can be in different places. So you need a fair value gap again in the move that expanded away from the order block, so that would be this move in the terms of this bullish trend. The next thing, you need to see no fair value gap near your stop loss. So if you were to take a trade from here and there was a fair value gap down here where a stop loss would be, you don't want to take that trade. It's going to lose. Like, it's a low probability trade. If you're very convicted that price is going to go up, let's just say in terms of this continuation mode, what you can do is cover the fair value gap with your stop loss, but I don't really recommend it. Honestly, if there's a fair value gap where your stop loss is, just call it a day, leave the trade and just move on. And yeah, the last one is just unmitigated. Unmitigated just means price hasn't moved into that area before, and that's really it in terms of the continuation model. So yeah, I'm just going to show you a couple of live examples of these trades so you guys actually train yourself with pattern recognition. But yeah, that's really all for the strategy. It's not really a lot. Okay guys, so this is an example of a trade I took. So in this situation, I was bearish on this day. We went up and swept some high time frame PD areas. I think we're showing like a H4 fair value gap. So from this point, my trade is valid, and I trade on the M15, but this strategy works on every time frame. If you like the M1, if you like the daily, if you like the H4, you can apply this strategy. So looking at what we have currently, let's just assume we're bearish on the day. And yeah, so literally looking at this, for me personally, we saw a sweep of these highs. It's an internal high, but I'm going to classify that as my high. So that's the liquidity sweep. We also had a sweep of these highs, so it's multiple sweeps. We had our chalk right here because we went from bullish to bearish. This is a chalk. I'm going to extend this line now so you guys can actually see. That's our chalk. We have the fair value gap in the expansion move. So in the case of this, we are bearish, so this move down will be our expansion move. It's always easy to spot an order block because there's always an expansion move before the order block, or after it rather. So yeah, in terms of the fair value gap, this was the fair value gap I needed to see. Let me just mark out for you guys so you can see it's a fair value gap. So we have our liquidity sweep, we have the change of character, we have the fair value gap. As you can see, this order block, this is the order block by the way, is unmitigated. That's the fourth one. In terms of the fifth one, we need no fair value gap near our stop loss. As you can see, in this scenario, there was one here. So I did not take this order block. I sat and waited for another order block to form. So I play it forward. As you can see, price did respect it, but that isn't completely valid for what we look for. But as you can see, price gave us another opportunity. So we had our liquidity sweep of these highs. I'm just going to call this the high. This is what I classify as a high. As long as any high or low, whether it's internal or external, it's a high. So we saw price sweep this. Let me just mark up as liquidity. So that's our liquidity sweep. We've had the break of structure, or chalk rather. It's the chalk of these lows. And I classify as a chalk because we saw this was a strong body close below. We had the fair value gap in the expansion move that moved away from the order block. So this is our fair value gap. So we have the liquidity sweep, fair value gap in the expansion move, the chalk. As you can see in this situation, there is no fair value gap directly above our stop loss. So that's 4. And the last one is price. This area is unmitigated. And that makes all 5 confluences present, which makes the trade valid. So all I'll do is literally get my entry position. I'm going to take this trade, but it is a back test by the way. I did take it live. So all I'm going to do is enter on the edge of the order block, stops just above the high. And this is the order block again, yet again, for those who don't know what the order block looks like. This would be my order block. I have it saved as daily order block, but it's just order block. So I'd enter something like this, just on the edge. Stops always above the high. How much above the high you want to put is always up to you. It's personal preference. I like to keep quite tight. So for aim in this strategy, aiming for the most recent low that's after price, where price is now, is always your highest probability low. But for this trade example, I am going to aim all the way down here. This is a H4 low, but that's what I'm going to aim for. And I do know price goes to that area because, like I said, I took this trade live. So yeah, so I'll take something like this, place the order, and yeah, that's literally just it. So playing it forward, and as you see again also, sorry, there's another order block here. We have our liquidity sweep of these highs, the break of structure. This candle didn't break structure because we didn't close below this low, but this one did. We have the liquidity sweep, the breakout structure. We have the fair value gap between here and here. Between this candle and here. That's the fair value gap. It's unmitigated because price hasn't come into this area. And then the last one is that there's no fair value gap above my stop loss, which would be above this high here. So that's another entry you could have to compound. So it just shows you that it works. So this will be another entry. So I'll place this one as another entry and we'll see. Price comes in and as you see, it hits take profit. So that's really just it for the strategy. It's not really complicated, but in terms of pattern recognition with the order blocks and with the strategy, just identifying all 5 confluences you need, I would say you guys should go and practice. So I would give you quote unquote homework, but I'll say go onto your charts and identify at least 30 valid order blocks with all 5 confluences. If you want to trade a strategy, that's the best thing you can do, because the easier it is to identify these order blocks, the better your trades are going to be. But make sure all 5 confluences are present. If you don't, you're going to take a lot of losses. The win rate in this strategy is about, I think, if you're very, very good with it down to the 1 minute, you can get up to 60-70%. But in terms of my win rate, it sits between 50 to 55% on a year, in a good year. But yeah guys, that's pretty much it for my strategy. It's not really a lot. It is more so a system than a strategy, so it does remove the emotional side from trading. But yeah, that's basically it. There's not really a lot more. If you like this strategy and want a more in-depth guide on how to trade it, if you want my countless hours backtesting this strategy, all my trade breakdowns, I'm gonna put my Discord down in the description below, so feel free to check it out. It is paid, but I believe the price matches the value I offer in the Discord. And there's loads of different people that can help you with the strategy, even if I'm not available personally. So yeah, that's really it for this video, guys. If this video was any help, make sure to like, comment, and subscribe. I'll see you guys in the next one.